Benjamin Graham didn't invent value investing because he wanted to get rich. He invented it because he watched fortunes disappear almost overnight and realized that most people weren't investing at all, they were gambling. That distinction changed the history of finance forever. And if you understand why Graham reached that conclusion, you'll never look at the stock market the same way again. In the 1920s, Wall Street was driven by excitement. Stock prices soared, speculation was everywhere, and many believed the market could only move in one direction, up. Ordinary people borrowed money to buy stocks, convinced that tomorrow's prices would always be higher than today's. Then came the crash of 1929. Wealth that had taken decades to build vanished in days. Fear replaced confidence, and millions of investors were left wondering what had gone wrong. Benjamin Graham experienced that devastation firsthand. He suffered enormous financial losses, despite being one of the brightest minds on Wall Street. Instead of blaming bad luck, he asked a deeper question. Why do intelligent people keep making irrational investment decisions? That question became the foundation of a completely new way of thinking. Graham concluded that the market was emotional. Prices often reflected excitement, panic, rumors, and headlines, rather than the true value of a business. If emotions could push prices far above or below reality, then patient investors had an opportunity. They didn't need to predict the next hot stock. They simply needed to recognize when a great business was selling for less than it was truly worth. This idea became known as value investing. At its heart are two timeless principles: intrinsic value and the margin of safety. Intrinsic value is what a business is actually worth based on its fundamentals, not the latest market buzz. The margin of safety means buying only when the price is comfortably below that value, giving yourself room for mistakes and unexpected events. To explain market psychology, Graham introduced one of investing's most famous teaching tools, Mr. Market. Imagine a business partner who shows up every day offering to buy your share or sell you his. Some days he's wildly optimistic and asks outrageous prices. Other days he's depressed and offers bargains. His job isn't to tell you what your investment is worth. His emotions simply create opportunities. Your job is to decide whether today's price makes sense. That lesson is just as relevant today. Markets now move at the speed of social media. A single viral post can send stocks soaring or crashing within hours. Artificial intelligence, trending sectors, and online hype may dominate the headlines, but human psychology hasn't changed. Fear and greed still influence prices far more often than logic. Perhaps that's why Warren Buffett, Graham's most famous student, built his investment philosophy on these very principles. Buffett often reminds investors that buying a stock means buying part of a real business, not chasing a flashing number on a screen. That mindset traces directly back to Graham's work. The greatest lesson Benjamin Graham left us isn't a formula or a shortcut to wealth. It's a way of thinking. Markets will always fluctuate. Headlines will always tempt us to react. But lasting success belongs to those who remain patient, think independently, and remember that the true value of an investment is determined by the business itself, not by the crowd's emotions. In the end, that's why Benjamin Graham didn't just invent value investing. He gave generations of investors a framework for making better decisions when everyone else is losing their heads.